Hello and welcome to the Business Standard Morning Show. I'm Thirumoy Banerjee and here's a look at the stories for the day. Not only farmers, senior officials sitting in RBI headquarters too hold their breath when weathermen come out with monsoon predictions in April. Relationship between rain and key economic indicators is well established. So, last week when private weather forecaster SkyMet painted a grim picture of the monsoon, shares of HUL, Nestle and Tata Consumers tumbled. But soon, India's official weather forecaster, the IMD, came out with its weather predictions saying monsoon will be normal. So, what does the forecast mean for the country's economy? Bhashwar Kumar brings you the answer.
The India Meteorological Department on April 11th predicted normal rains during this year's monsoon season at 96% of the long period average or LPA, in spite of the anticipated El Nino conditions. While it is categorized as normal, the forecast is at the lowest end of what the IMD categorizes as normal rainfall. In effect, the 4-year run of good summer monsoon rains that India has witnessed could come to an end this year. This is IMD's first official monsoon update for the year. A monsoon season is considered normal if it receives rainfall of 96 to 104% of the LPA. The LPA is the precipitation recorded over a particular region for a given interval, averaged over a long period, like 30 or 50 years. The forecast by the state-run weather agency came a day after SkyMet, India's private weather agency, said that there would be a below-normal monsoon this year due to El Nino, which is the warming of the Pacific Ocean near South America that weakens monsoon winds. SkyMet's forecast that monsoon rains will be 94% of the LPA could pose a potential risk to India's crop output. Not only does agriculture account for 2/5 of India's food production, it is also a source of livelihood for slightly less than half of the country's population.
This variance, firstly, it's not very large. SkyMet has given 94% of long period average and IMD has given 96%. Practically and literally, I will say this is almost consensus of forecast. 94 and 96, difference is just about 18 millimeter of rainfall for the season, which amounts to 2 days of monsoon rainfall.
However, what these forecasts mean for the economy depends on their accuracy. A recent report by National Daily revealed that in the past 10 years, IMD's first long-range monsoon forecasts, which are issued in April, have been off the mark by 6.9% on average. This is higher than the accepted 5% error margin of the forecast. However, IMD's second long-range forecasts, issued in May-June, were slightly more accurate, with an average departure of 5.9% against an error margin of 4%. In the past decade, SkyMet has also had a mixed record with its first monsoon forecasts, which have seen departures beyond the margin of error in some years. Yet, experts believe that IMD's departures are not too high. With that in mind, what does its forecast mean for the economy? After all, on April 6th, the RBI MPC marginally hiked its GDP forecast for FY24 to 6.5% from 6.4% projected earlier. It also slightly lowered its projection of retail price inflation for FY24 to 5.2% compared to 5.3% expected earlier. One of the factors that the MPC based its projections on was a normal monsoon.
Our forecast is 6% growth and 5% inflation. The IMD forecast doesn't change that because we had assumed a normal monsoon. We assume agriculture to grow at 3% if this forecast holds. But one should also keep in mind that in the month of May, they'll revise their monsoon outlook again when more information becomes available. And in this day and age of climate change, etc., I think you have to wait for more reliable information.
However, possible complications are plenty. For one, there's a possible impact due to the anticipated El Nino conditions. Second is the monsoon's interspatial distribution. The IMD expects normal to below normal rains in some areas of northwest India, parts of west central India, and pockets of the northeast. Normal rainfall is likely over many areas of peninsular India, adjoining east central India, east India, northeast India, and over parts of northwest India. In a significant portion of the country, all three probabilities, which are below normal, normal, and above normal rains, could occur.
Both temporal distribution and spatial distribution, they matter most. It matters more than what we work out with a figure, whether it is a 94% or 96%. What matters most is the rainfall distribution. But there are a few pockets, yes, which are rainfall dependent, monsoon rainfall dependent, where any large deficiency, particularly over the central parts, western parts, it matters, yes.
The chatter on El Nino impacting rains was getting louder. I think it's got silenced a bit after IMD's prediction. To what extent I think the economy will be impacted? Critically, I think it depends on how well the rains are distributed, even if they are a little lower than the normal. I think distribution over time and over geographies is extremely critical. And by the way, I think there is some regional disturbance predicted in the monsoon, but you tell me which year we haven't seen that. I mean, so the issue is that it should not be extreme.
Along with the evolving monsoon and El Nino situation, Joshi also called for monitoring the impact of other weather events like heat waves on agriculture, which has been a weak spot in the overall economic story. Ultimately, it is important that the IMD forecast holds, because a poor monsoon will impact kharif production and thus keep inflation on the higher side.
Most experts, meanwhile, agree that Q4 will end on a good note. A good monsoon played a key role in it, and another round of good monsoon will pave the way for another impressive earnings season. Speaking of the private sector, the country has seen several urban centers metamorphose into the favored destination for companies over the years, like Bengaluru and the National Capital Region. Ahmedabad seems to be latest in the line. From industrial giants to startups, all are rushing to establish a base in the city. So, is Gujarat's financial capital emerging as the next corporate hub of India? Debarghya Sanyal answers.
Employees of ACC and Ambuja Cement, which were acquired by the Adani Group last year, were recently taken by surprise when their new management decided to shift several key roles from Mumbai to Ahmedabad. But while the employees struggle to cope with the change, the move is symptomatic of a larger shift in the Indian corporate space. The list of companies shifting their base of operations to Ahmedabad is growing rapidly and now spans across sectors. And the country's biggest conglomerates are leading the way. It is not just Adani. Reliance Industry had moved the registered offices of its 5 subsidiaries to Ahmedabad in 2019. Gujarat's commercial capital is also well connected with emerging manufacturing and financial hubs in the state. Work on bullet train project, which will connect the city to India's financial capital Mumbai, is also on. And just a stone throw away and soon to be connected via metro is Gujarat's Gift City, a planned business district which has India's first international bullion exchange, branches of major international financial institutions like JP Morgan Chase, Deutsche Bank, and Mitsubishi Financial Group, as well as its own futures trading operations. On the other hand are industrial complexes like Sanand, Vani, and Dholera. These industrial complexes are becoming a major draw for sunrise sectors like semiconductor manufacturing. After the $20 billion investment commitment by Vedanta Foxconn to set up a semiconductor fab in Dholera, US-based data storage device manufacturer Micron Technology is also finalizing the allotment of a 3 lakh square meter land parcel between Ahmedabad and Sanand for another mega fab. Armed with such happening financial and industrial complexes, Ahmedabad seems to be poised to join a long list of urban centers like Kolkata, Mumbai, Bengaluru, Gurgaon, etc., which have from time to time emerged as the country's go-to corporate destinations. In fact, as experts point out, attracting corporate investment is essential to any state government policy.
State governments have been competing with one another to attract investments into the state. So for companies to move to any specific state or plan to locate their factories or production houses or even their captive centers or service centers, etc., and the state government has to be welcoming of the company and the factory into their state and make conditions and offer concessions to set up the factories. I think many of the progressive industrial states in India like Gujarat, Maharashtra, Tamil Nadu, etc., have been very proactive in attracting investments. Of course, underpinning this is also these clusters and the availability of talent and the surrounding, I would say, ecosystem.
So, what makes Ahmedabad the right destination for corporate majors in India?
Ahmedabad is a place where almost everybody is an entrepreneur. Add to that we've had multiple decades of excellent municipal organization in Ahmedabad. You will see the development of multiple corridors across the length and breadth of the city. It has all the makings of a great hub, great access to raw materials, tremendous connectivity. The access to rural hinterland also is excellent because of the road infrastructure that has been created. The ease with which material is available, permissions are available, and occupation certificates are available is just astonishing.
With companies shifting their factories, investments, and captive centers to Ahmedabad, headquarters and bases of operations are also likely to follow, as was evident in the case of ACC and Ambuja Cement. However, if the trend is to continue, Ahmedabad needs to address a few challenges.
Natural challenge is access to a port. The time that it takes for goods to reach a port is a constraint that Ahmedabad cannot overcome. But what they can do is to make sure that the containerization happens at factory exit level. The other challenge that Ahmedabad faces is the attractiveness of people from across the country to want to come and stay there, largely because of the infrastructure of schools and colleges. But that also is being addressed massively. We have the tremendous benefit of having IIM Ahmedabad located there.
For companies to shift to Ahmedabad, I think still more investments in talent. If it makes investments in education and talent and proactively attracting the services industry, I think it could be much more bigger play for Ahmedabad to become a much more vibrant, city for business in India.
While Ahmedabad seems to have made an impression on the country's major industry players for its ease of doing business and strong infrastructural setup, the city still has miles to go if it were to emerge as the country's next corporate hub. Experts point out that the city needs to evolve into a more cosmopolitan and interconnected urban center.
Erratic crude oil prices too affect the margins of companies just like the monsoon. Paint companies are eyeing margin recovery from Q4 onwards after being beaten down for several months. But volatility in crude has returned to haunt them. So is it time to buy stocks of paint companies? Harshita Singh brings a report. Paint stocks have been badly hit over the past 6 months as volatility in crude oil prices, which is their key raw material, kept investors on the edge. Shares of Asian Paints, Berger Paints, Indigo Paints, Nerolac and Pidilite tumbled between 6 and 32% during the period versus a 3% rise in the S&P BSE Sensex. And with the recent output cut by OPEC+, analysts expect the crude oil prices to inch higher, which in turn can impact margin recovery for paint companies.
Crude prices corrected from its high of around $120 per barrel to the lows of around 75 per barrel. So the benefit of this fall will definitely happen for the paint companies, and we expect EBITDA margins of paint companies to be higher in Q4. However, the recent step undertaken by OPEC, where they have cut the production, and because of which we have seen crude prices moving up to $85 per barrel. So this kind of movement is not good for the paint companies, and if crude prices move back to around $100 per barrel, I think it will add pressure on the EBITDA margins of the companies, maybe from Q3 of FY 2024. We believe that Asian Paints is one of the portfolio stocks. So investors who have a long-term horizon can invest into Asian Paints, and we have a buy rating on this stock. However, the investment having a short to medium term perspective, I think paints is not preferable. We believe that the volatility in the crude prices, entry by some of the large players in the paint sector would keep a toll on the valuation.
That apart, rising competition is another factor that has kept investors downbeat. JSW Paints, JK Cement and Aditya Birla Group firm Grasim aim to make inroads into the industry. Grasim is eyeing to be the second largest paint player with a capital expenditure of 10,000 crore rupees, which is 50% of the total sector outlay, likely during the next 3 years.
In terms of Grasim entry into the paint sector, I think it will definitely intensify the competition in the space. Grasim is one of the large players and it has a strong dealer and distribution reach for its cement business, which it can leverage upon to expand its paint business. But we believe that the larger competitive impact will be seen on the smaller players or the regional plants than the for player like Asian Paints, because Asian Paints already has a commandable market share. Impact for Asian Paints would be minimal, though we might see pricing power coming down in the over the period of time.
The competitive intensity, analysts at Jefferies said, could force incumbent players to take significant price cuts in a bid to save market share. According to its recent report, the magnitude of Grasim's investment will likely push it to aggressively ramp up by entailing channel push, higher discounts and promotions for dealers and painters. This could impact the industry's profitability, at least in the medium term. Among stocks, the brokerage advises selling Asian Paint stocks on the rally. This week, markets will react to the March 2023 quarter numbers of TCS and Infosys amid global cues. Global crude oil prices had soared to $120 a barrel last year when Russia invaded Ukraine. A somewhat similar situation seems to be building up in the Pacific Ocean now. China recently concluded a 3-day military exercise around Taiwan. There were simulated attacks on Taiwan, the encirclement of the island, and its sealing off. This is not the first time tensions between the two nations have escalated. There is a long history to it. Raghav Agarwal explains.
Taiwan was under Chinese control in the 17th century during the Qing dynasty. In 1895, the dynasty gave it to Japan after losing the First Sino-Japan War. In 1945, after the Japanese surrendered in the Second World War, the island was handed over to China again. But a civil war erupted in the country between the Nationalist Party also called Kuomintang, led by Chiang Kai-shek, and the Communist Party, led by Mao Zedong. In 1949, the Communists won the war and took control of Beijing. Mao's opponent Chiang Kai-shek, along with other officials of Kuomintang, fled to the neighboring island of Taiwan. He ruled the island for several decades. China considers self-ruled Taiwan as its breakaway province, and the Taiwanese government fears that it will eventually annex the small island. Taiwan argues that they were never a part of mainland China and are a separate nation. Only 13 countries have recognized Taiwan as a sovereign country, and India is not one of them. In 1992, both sides reached a consensus on one China, but the definition of China is different for Beijing and Taiwan. Beijing said that there is only one China, including Taiwan, and it is run by the Communist Party of China, but Taiwan maintains that it must be run independently. In 1979, under the Jimmy Carter administration, the US stopped recognizing Taiwan as main China. On March 16, 2018, the US Congress passed the Taiwan Travel Act, encouraging diplomatic visits between the two countries. And on May 23, 2022, Joe Biden, during his trip to Asia, vowed to defend Taiwan with the US military in case of an invasion by China. The world is dependent on Taiwan for its semiconductor needs. Over 60% of the world's semiconductors and over 90% of the most advanced ones are made in Taiwan, and most of them are manufactured by Taiwan Semiconductor Manufacturing Corporation, or TSMC. Global automakers to phone manufacturers like Apple are dependent on TSMC for semiconductor supply. Relations between Taiwan and China deteriorated sharply after Nancy Pelosi, the then US House Speaker, visited the island in August 2022. China launched military exercises around Taiwan. It said the visit was extremely dangerous. Since then, the Chinese military has regularly conducted sorties in and around Taiwan.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Meanwhile, French President Emmanuel Macron has surprised everyone by suggesting that Europe should not follow US policy on Taiwan. That's all for today. For more news and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.